If you are watching the headlines this week, you are seeing that the U.S. is considering a financial bailout for Argentina. And I'm here to tell you that this matters to you. Maybe not precisely what happens in Argentina, but the bigger story about what's happening in the global economy. You need to know what you should do about it and also what it means for gold. So, stick around for a quick explanation of the global economy and an explainer on how watching a single number around the globe can show you just what will happen next. Here's the story. Argentina had an economic golden age at the start of the 20th century. It was one of the richest countries in the world. But since then, it's been in and out of default for about 100 years. It's a wonderful, beautiful country, but its people have been through a lot of economic upheaval. Argentina borrowed, spent, defaulted, and borrowed again in a cycle of poor economic policy and planning. And back in 2017, Argentina issued a 100-year bond. And I remember writing to our readers at Stansberry Research saying that these bonds were insane. The country defaulted in 2001, and then in 2014, and then in 2017, they want to sell a bond that will mature in 2117. And somehow, they found buyers at around 8%, and of course, Argentina defaulted and had to restructure by 2020, only 97 years short of its 100-year goal. Anyway, Argentina's troubles today look a lot different, and they highlight a critical weakness in global markets. So Argentina's libertarian president, Javier Milei, took over in 2023, and he had a plan to radically overhaul the economy, removing many government programs and focusing on building a more free market-driven country. Now, whether Milei's plan was genius or folly will depend on your own beliefs, and I'm not going to attempt to judge that here, but both proponents and opponents admit that Milei's shock doctrine would cause lots of short-term pain, in particular, job losses and higher unemployment. The open question was, if Argentina could push through the pain, would it lead to greater economic growth and opportunity down the road? Now, we likely won't find out. Argentinians and markets have lost the will to keep pushing through that pain. The economy has stalled, the currency is crashing, and Argentina may need a lifeline from the U.S. to keep its economy from completely crashing out. This week, the U.S. government floated the idea of providing financial assistance to Argentina. Reporters say there's been a discussion of a $20 billion bailout. So, ironically, this experiment in free markets may end unless the libertarian Argentinian president accepts a foreign government bailout. Now, even everyday investors with a few stocks and a 401k should take heed of this news. There are important lessons here. What may be the death blow to Milei's plan didn't come from inside Argentina. It came from global financial markets, right? Investors ditched Argentinian bonds and crashed the peso. And that's what's turning Argentina from an economic slowdown to an economic crisis. But this effect is not just happening to Argentina. It's happening around the world, here in the U.S., in Europe, and beyond. Global investors no longer want to hold as much government debt as they did a few years ago, whether that be in Argentina or otherwise. And you can follow this whole story by watching something very simple, and that's the interest rate on government bonds. So let's look at the U.S. The story we're told here is that the Federal Reserve is cutting rates, and so interest rates should go down, and that lowering rates will make borrowing easier for consumers and for the government, and that will shore up our economy. However, central banks only control one short-term rate. They can change what's called the overnight rate, but the rate on longer-term borrowings like 10-year bonds are set by supply and demand. The supply comes from the governments. More deficit spending means greater supply. And demand comes from global bond investors. So if you look at the 10-year rate on U.S. bonds, it's not coming down. Even though short-term rates are lowering, investors are not driving the rates on 10 years lower. There is a battle happening here. The Fed wants to push down rates, but they aren't moving yet. This is extremely important to watch. And while the U.S. rates are flat, if you extend this analysis around the world, you see the same effect, but bigger. If you look at the long bond rates on big established countries around the globe, they're all flirting with 10-year highs. I'm talking about Germany, Japan, France, the UK. I could go on to list more. The rates are going up. These aren't serial defaulters either. These are traditional safe haven sovereigns. And this matters because higher interest rates create their own problem for government balance sheets. Higher rates mean higher borrowing costs. Therefore, it costs more money to service the debt. For example, here in the U.S., projections show almost $23 trillion in deficit spending between now and 2035, but that is if rates drop to a projected 3.8%. If they stay around 4.3%, it would cost us an extra $1.6 trillion. That is a huge 3.6% of GDP. So higher rates worsen national balance sheets and lead then to even higher interest rates. Now, the Fed is trying to drive interest rates lower, but the bond market may not let them if it doesn't trust debt levels. And looking internationally, this shows that this is a big global effect, and that tells me it won't be easy for any single central bank to push interest rates lower. Now, here is where that leaves investors. The basic macro playbook says if rates are headed lower, buy stocks and bonds. And lots of people are putting that playbook to work, betting on higher asset prices because of lower rates. But the Federal Reserve only has a certain amount of power. You need to watch these 10 and 20-year bonds rates to see if the Fed playbook for lower rates will play out. And they can only go lower if the bond market agrees. So if that's not the playbook, what should you be doing? Well, I've said on this show before, the macro scenario still points to gold. Global debt concerns favor gold. Lower interest rates favor gold. Fears of recession favor gold. Central banks are buying, and gold is continuing its dramatic breakout past all-time highs and on towards $4,000 an ounce. Outside of gold, this should drive all metals and commodities higher. Silver, copper, others all play the same game. And you should also continue to focus on an internationally diversified portfolio. When monetary or fiscal decisions pose a risk to your wealth, you don't want to trust any single country to make the decisions that will benefit you. So diversify your portfolio around the world. You can have specific stocks or funds that I've talked about. Cambria Foreign Shareholder Yield Fund, FYLD, Schwab International Dividend Equity Yield Fund, SCHY. These are the precise things we've been covering here at This Week in Wall Street, and it will continue. We'll continue to cover it as this plays out. So, for now, watch those long-term rates and stay tuned. And to hear more about this incredible breakout in gold, I brought in Brett Eversole. He's the editor of True Wealth here at Stansberry Research, and he invests based on a careful study of what assets are trending around the globe. He's central to our gold coverage here at Stansberry Research. So, Brett, I brought you on the show here in March when gold crossed $3,000. You said we weren't anywhere near the end of this bull move in gold. Now we're flirting with $4,000. Is there still room for gold to keep going up?
Yeah, Matt, thanks for having me, of course. And to me, the answer is unequivocally yes. And it's funny, you just gave a lot of really good fundamental reasons for why the gold price could go higher. I'll be honest, I don't really care about any of that. I just think about buyers versus sellers and kind of where we are in an investment cycle. So gold is up 40% this year. It has roughly doubled over the last 2.5 years. But from what I see, no one really seems to care. No one is interested in gold. You're starting to see a few articles pop up here and there talking about this massive move that's happened this year, but we are nowhere near what I would consider like a mania stage in gold. I'm sure when I came on here last time, I talked about what that mania felt like in 2010 and 2011 when I first got into this business, and you just could not escape the boom that was happening in gold at that time. Everything in the financial media was kind of aligned with that massive boom that was going on. Everywhere, street corners, people were spinning signs to get people to come into the gold shops to sell their old jewelry. Like, it was a true mania. None of that's happening today. So we've got prices rising, but people simply just don't care. And to me, that tells me we are not anywhere near the late stages of this boom, despite the fact that we've had this massive rally. It means that we are simply in the middle of a long-term boom that's going on. So I see much higher gold prices over the next, 12, 18, 24 months from here.
Yeah, I remember. I mean, when it even gets to the commercials and everything is cash for gold, that's when you know a real boom is on. So, I've talked, like you said, I talked about global debt, central bank buying. What other drivers of gold am I missing that you're seeing out there?
Yeah, so again, to me, it's kind of like like I said before, it's like buyers versus sellers. And central banks were very important. They're really what got this going. Central banks in 2022, 23, and 24 bought over 1,000 tons of gold. And that was about double what they were buying in the 6 to 8 years prior. They're still buying in a big way. So in 2025, that number is probably going to be around 900 tons, so a little bit lower. But what has happened this year And it's this beginning, again, not the beginning, not the end, but retail investors are beginning to get interested for the first time. One of the things I like to look at is the shares outstanding of the large ETFs that own gold. There are two main ones, and those for the first time in 2025 have actually started to increase. So when these funds have more demand for the assets they own, they create or liquidate shares based on demand. So when you see share counts rising, it means people are buying these funds in a big way. If you look back at the history of kind of how speculative booms happens, they always happen the same way. You've got kind of smart money institutions that buy it first, then retail comes in because they see those big returns, and they're what turn a boom into a mania. So I think the retail investor is starting to get interested for the first time, but we're nowhere near that mania stage. I pinged a gold coin dealer that I spoke or that I know well yesterday, and he said that he's starting to see some buyers come into the market, but they still have a lot more demand from sellers than they do from buyers. So retail's starting to get interested, but we're nowhere near that mania stage, and that mania stage will come. It always does. Gold is one of those asset classes that when it gets going, it goes crazy every single time, and I expect that to happen. But again, we're not there yet.
Yeah. Wow. Okay. So if someone missed this gold boom and they're a little trepidatious about that price, are there other plays that you think have room to run that are kind of in this general theme?
Yeah, well, I would say two things. The answer is yes, but I would also say don't make that foolish mistake. Just because gold's at $3,800 an ounce, you have not missed it. If you tell yourself that, then you're going to sit on the sidelines for the end stage of every single boom that's going to come along throughout your lifetime, and you're going to miss out on some of the biggest returns. So, I mean, I think we're going to see $5,000 to $6,000 to $7,000 gold by the time this is over. So I don't think you've missed it. Having said that, I do think silver is a much more interesting opportunity today. So silver tends to not really get going until that retail mania stage of a gold boom takes place. So silver has been going up a lot this year because we're starting to get into that. But one of the things I like to look at is the gold to silver ratio. It's just how many ounces of silver does it take to buy an ounce of gold? This was over 100 earlier this year. It was the second highest we've ever seen. It's now come down to about 85 today. I think a historical normal level is probably in the 40 to 50 range. So, if in my view, gold could maybe double from here by the time we hit a peak, silver could 3 to 4x from here by the time we hit that peak, if you use that kind of rough math, with gold prices going up and then the gold to silver ratio going down on the trajectory it is. So I think that's a much bigger opportunity from here.
Okay. Wow. Okay. So for an investor who's new to this stuff, give us the breakdown here. You can go buy gold bars or coins, but how does someone do this? How can they get invested in gold right in their regular brokerage account?
Yeah, it doesn't. You can definitely do that, but I mean, in my mind, that's a very different kind of investor, like who they are and what they're after. So to me, the simplest way is the big ETFs. The biggest one is GLD is the ticker, the Spider Gold Trust. You can buy this in any brokerage account. It's going to give you access to the moves that are happening in the gold price. It's just a very simple product. Similarly, if you want to buy silver, you can do SLV, which is the iShares Silver Trust. The exact same idea. It owns a bunch of silver. You buy it. You're going to get the return of whatever that silver price does. Now, if you want to be a little more adventurous with gold, and I will say that this is a little riskier, but you can buy leveraged gold ETFs. The one that I like is ticker UGL, which is the ProShares Ultra Gold Fund. Now, these are designed so that they'll go up twice the daily change of the price of gold. The way that's structured, you end up having this decay, and the details of how it works is not important, but what it means is when prices go down, this thing will go down a lot. So you do have to be a little more strategic with owning it, and realize that if we have a lagging time, even in a big bull market, you could lose a lot of the returns you've racked up. So that's a thought, but it's something you need to be a little more aware of, I would say, going forward. And then obviously, a great way to take advantage of a gold boom is through gold mining stocks. Because of the way the operational leverage of these businesses work, when the gold price goes up, their profits can go up dramatically. And because of that, you see these gold mining stocks absolutely soar, even when gold just goes up a little. So as a reference, gold, like I said, is up about 40% this year. The major gold mining ETF, it's ticker GDX. It's the Van Eck Gold Miners Fund. That's doubled this year. So we've seen gold go up, a big move. We've seen gold miners go up dramatically more than what we saw out of gold. And I think that we'll probably see that happen to continue to happen over the next few years as gold prices move higher and higher and higher. So those are four, I would say, relatively simple ways to get access to this trend that's going on in very different ways.
Yeah, well, lots of options for investors with these modern financial markets. Watch that leveraged one, of course. That's only suitable for, well, it's risky, but only suitable for short-term holdings, right?
Yeah.
One last thing, if folks at home want to hear more about gold, the economy, specific investments, and more, Brett and I will be hosting the Stansberry Conference in October. We'll be live in Las Vegas, but you can live stream it from the comfort of your home. We'll be joined by incredible speakers and experts, Kara Swisher, Peter Diamandis, Josh Brown, experts in AI, geopolitics, investing, real estate, health, and more. You can find out more at mattvegas2025.com. There's a link in the description below. You can join us and watch it all live. We've been hosting this conference for 23 years. They're always great. You never know what's just going to happen. Brett, I will see you there, and thank you for joining today. And as always, like and subscribe here on YouTube, and I will be back next week.